Welcome to the Investor Agent Podcast. I'm Steve Seymour, your host, where we help transform the human mindset from scarcity and lack to abundance and wealth, one conversation at a time. Steve Seymour here with the Investors Agent Podcast. I have Ashley Wilson as our guest. Ashley, thank you for being on today.
Thank you so much for having me.
So Ashley has Bar Down Investments, large real estate holdings company. And we're going to dive into how she got started, but also what she's doing today. So I like to kick it off and kind of get an idea of what got you into real estate, what triggered that thought process, and then how'd you take action?
In 2007, my now husband and I were doing quite well with our W-2s, and we were looking for a way to diversify our retirement strategy. We were not huge fans of the stock market, so we looked for alternative investment opportunities and stumbled on real estate. And fast forward 2 years later, we purchased our first investment property. We did a combination of both house hacking and short-term rentals out of that property.
How do you combine those two real quick?
We lived in the house for 9 months out of the year, and then the other 3 months of the year, we short-term rented it. So we did Airbnb.
Nice.
During those 3 months and during the 9 months, we house hacked. So my husband was a former professional ice hockey player. So we would live in a city for 9 months and we would rent out the other rooms to his teammates. So not only did it offset our expenses, but we actually made money during the season and lived for free. And then during the summer, we made even more money by doing short-term rentals.
It's a great way to get started.
Yeah, it was, I mean, we were hooked, obviously.
Yeah. That's awesome. And then talk a little bit about your progression in real estate.
So after the short-term rental, we started to do a couple other longer-term rentals, but all single family. We didn't do any multifamily at that time. And then in 2014, I resigned from working in the pharmaceutical industry. I worked in clinical research and development for a few major pharmaceutical companies, and I was very focused on operations when I worked in the pharmaceuticals. So what I ended up doing was transitioning from working in pharmaceuticals and operations to partnering with my father and starting a high-end flipping business where we flipped homes, historic homes along the main line of Philadelphia, outside of Philadelphia, Pennsylvania, and started this whole house flipping business that we had for 8 years. And then towards the tail end of that, then I transitioned into multifamily and bought large apartment buildings, primarily through the use of syndication, but we also have JV'd as well.
All right. So that sounds like a very quick scale up process compared to most people, right? Obviously, shouldn't compare to anyone because you should only compare to yourself. But from my experience, to see someone go from short-term rentals to flips, then to large multifamily, that had to have taken some internal grit along with maintaining a very abundant mindset, along with strategy, coaches, mentors. So tell us how did you scale up so fast? And I know that's like a very broad question, but what would you say, separated you from the people that have got into like, say, short-term rentals or long-term rentals and then kind of got stuck there? Like, how did you scale up?
Well, first is I have a philosophy that everything is figure outable. So in terms of whenever I would come into a new asset class, I would try to figure it out as quickly as possible so I could put systems and processes in place to automate as much as I could possibly do to scale. I think that's the secret behind scaling. And then that inevitably frees up your time so you can look for additional opportunities. And there are truly opportunities all around. I mean, everywhere you look, there are opportunities in all these different asset classes. So to your point, a lot of people get stuck because they kind of get into what, they're comfortable with and get complacent. And they don't look to say there's got to be an easier, better, faster way in which I can grow and scale. And some people don't want it. I'm not going to say that that's the only way you can be successful. But for me, what I did is I always wanted to emulate my next role model. So I would look for a role model that was where I wanted to be and figure out how they did it. And then I would try to do it faster than they did it. or better than they did it. And in order to do that, you have to understand all of the details of what they're doing. And that's tough. That's really hard to do. But in the end, success leads a trail, and picking up all those breadcrumbs and then piecing them together and figuring out how you can do it better is something that I've always strived to do.
Yeah. So I see the progression from a lot of people, either wholesaling, then flipping, then some rentals. And I want to pinpoint the jump between high-end flips, which is, I know you were doing some really high-end flips, which is, that alone is impressive. But going from that to owning 1,200 plus stores, $120 million plus real estate, nationwide, that's a huge jump. Mm-hmm. So what was that internally that had you say, like, this is possible? Was it, I know you said emulating others. Did you just stumble across it? Did you seek it out?
I think as entrepreneurs, we naturally want to do everything ourselves. That's why we gravitate to real estate in the first place. And what we don't realize is we're almost our own wall, because we don't think to build out teams and systems to get us to the next level. We were probably all that, fifth grade kid who was assigned a group project and took everything on themselves and told all the other people in the group, oh, I got to just show up when we need to present. But at the end of the day, you need all of those other people to help you carry the weight to get to the next level. So when I was looking to scale, what I realized is there's only so much I could do without bringing people in. In fact, I think I actually am behind where I should be, because it took me 2 years to figure out that having more people isn't more mouths to feed, it's more hands to sew. And if you bring in the right person, not only should they carry their expense, but they should, and on some multiple, bring additional value into what you're doing. So maybe that's 2x or 3x what you're doing, or maybe it's more than that. It depends on your business and it depends on the position, but they should always bring a multiple in to not only cover their costs, but the value that they're adding. So I think when I looked at it that way, I figured out systematically how to actually execute it. But then tactically, the way I did it was, I constantly get approached by people who say, I want to work for you, I want to learn from you, but what they fail to do is lead with value. And I'm a firm believer in leading with values. So the way that I was able to jump from not even owning a duplex to owning 124 units as the first multifamily property I did was because I went to someone I looked up to at the time and said, I want to get into commercial real estate, and here's the value I add. I can manage construction projects. I'm extremely knowledgeable about construction management, and that is a way that I think I could leverage an existing skill set that I already have to help an existing team. And his response back to me was, do you want to partner on this 124 unit because one of the buildings just burnt to the ground and no one on the team knows how to rebuild a building? And I said, yes, I'm in. I know how to do it. And the rest is history. So that's how I was able to get my foot in the door. And it was literally one conversation. It was one conversation I had. It's the same way that I was able to tap into bank loans with only a year of a flipping history. Everyone else told me that I needed 2 years tax returns to tap into getting a bank to loan to me for flips. And I knew that that couldn't be possible. I knew that there had to be another way.
Everything's figure outable, I think, as you said earlier.
Exactly. So What I did is I invited the lender to a property I was doing at the time, and I spoke in their language. I didn't send them a packet full of all these flashy pictures, because lenders don't speak in terms of visuals, they speak in terms of numbers. So I brought them to the property so they could physically see what I was working on, and handed them a packet of the previous 2 projects I had done with all of my forecasted numbers and my actual numbers, and an explanation anytime it wasn't spot on to the penny. And that wasn't just inclusive of when I had a shortfall, it was also inclusive of when I did exceptionally well, and to explain. And his response back to me was, I'll loan on whatever project you do next, because I loan to people with over 20 years experience and no one is as organized as you are.
Yeah.
So that in it of itself gave someone trust, and it was all about speaking the language. And once again, leading with value. My value is I focus on the details and I'm going to protect your investment. And the lender could see that.
Yeah, that's huge. And I've really liked how you went about from going from not even owning a duplex to 120 plus unit building by finding someone who was already in that space, figuring out what did they need, and then bringing value to it. So it's amazing that, you were able to connect the dots where so many people get stuck. And you also came in with not this scarcity mindset that this whole deal has to be all mine, right? You were grateful for the opportunity to even participate in a deal like that, and probably, brought a ton of value on the construction side. So tell me a little bit about, what you guys are doing now. What do you see in this market? I know a lot of people are like, what's happening with the market? Are you guys seeing cap rates coming down at all? Are you, no, you're not seeing any softening and no?
No. So what we're doing right now is we're continuing to do what we do best, which is be consistent. So right now, the best time to solidify a relationship with a broker, which is the number one way in which most people are getting their properties, is to continue to have the conversations and let the brokers know that you're still wanting and willing to buy properties. Obviously, the cap rates and the debt markets are really the driver behind the cap rates. But ultimately, there is still a gap in sellers' pricing expectations and buyers' pricing expectations. 6 months ago, it was about a 35% spread. And right now, I think it's about 10 to 15%, at least in the markets that we're going after. So I think there's still a gap, but I also think there is a lot of distressed assets that are not only on watch lists and about to be foreclosed on, but are actually being foreclosed on. And I think people who are holding steady, not necessarily putting on the brakes and not willing to buy if something comes along, but still being consistent, still making those connections and trying to figure out creative ways. For example, we have access to data where we can pull DSCRs on properties, which are debt service coverage ratios. And typically lenders want to be around a 1.2 to 1.25, but the closer they get to 1 or even below 1, the lenders typically put those properties in cash management situations with lock boxes. So in terms of all of the expenses, the lender controls the property's finances and pays out to make sure they're getting their money, and the properties won't have a tremendous amount of liens on them. And then eventually they foreclose on these properties.
Yeah. So you think some people are holding on too long, and there could be a little bit more, there could be some softening coming?
There could be a couple things. Number one is the fact that the history of the debt market was the fact that people just got greedy and wanted to only secure properties under floating rate debt because they kept thinking that the debts would get lower, the rates would get lower and lower and lower. So they would do floating rate debt. And what ended up happening is it kind of backfired. And I don't think anyone could have predicted the extreme in which it backfired with COVID and the what the Fed is doing with the interest rates. But that being said, that has put a lot of properties in precarious situations because of rate cap accruals. So lenders required properties to have rate caps to, prevent from a situation like this happening and crippling the commercial lending market. But what it is doing is because of the fact that you have to, just like insurance and taxes, you have to accrue those expenses throughout the year. The mortgage company requires you to. They also require you to do it for rate caps, and that's putting really a tight compression on cash management position on these properties. So I think that's part of the issue. The other part of the issue is that cap rates are a historic look at what properties were trading at anywhere from 3 to 6 months prior, and that is because of cap rates are a reflection of the sale price, and the sale price often doesn't get reported out for a few months. So people are quoting cap rates today, but cap rates today are really reflective of a few months ago.
So there's a lag there.
There's a lag not only on the sale, on the disclosure of the sale, but also think about it in terms of when the property went under contract. So the typical contract period is anywhere from 60 to 75 days in commercial real estate. So then you're having, that's why I'm saying it's almost a 6-month lag time. And I think last year, if we look 6 months ago, we're nearing the end of Q3 in 2022, and there was still a lot of 1031 money circulating in the markets, which inflated prices because people would rather overpay a property by $2 million than pay a $3 million tax hike or tax hit because they sold a previous property and they had nowhere to place that capital.
Right. But now that that's more expensive, it's harder for them to do that.
Exactly.
Now, can you tell me a little bit about your strategy and, just you don't have to dive too deep on it, but I know talking to you previously, cap rate wasn't the most important number you were looking at, right? Because a lot of it was rent growth and value add, specifically with your strategy. I'm sure cap rates are important, right? But more so knowing what will things be selling at in a few years from now.
So cap rates to me, first of all, the definition of a cap rate is it's a reflection of a property that's stabilized. So the properties I purchase and our company goes after aren't stabilized assets. They're distressed assets. So the going in cap rate doesn't hold as much weight to us as the exit cap rate. And the exit cap rate is in part determined by the debt markets because you can only pay for a property what your cost of capital will allow you to pay. So for example, even on single family, let's say, for example, your cost of capital is 10% versus 4%. Someone who's paying 4% on their capital can afford to pay more than someone who's paying 10% on their capital. The same is true in commercial real estate. So I think when, we look at that conundrum, we are in a situation where the cap rates to us don't matter as much on distressed assets as much as the potential for that property to grow its value. And then how does that translate on a future pro forma? So we typically hold our properties from, let's say, 2.5 to 5 year window. So what are the debt markets going to look like then? And then how are the cap rates going to be reflected? I don't think anyone knows the answer to that.
I was going to say, how do you forecast that, right?
It's really difficult. I mean,
kind of do best case, worst case scenario. And
we stress test it. We also, the industry standard historically has been 10 basis points per year held. So if you're going in at a 5 cap and you're holding for 5 years, you would typically underwrite a 5.5. I actually posted about this on LinkedIn a couple of weeks ago where I did a survey to see what people are doing. Are they doing the industry standard of 10 basis points per year held? Are they not expanding the cap rates because they think that the debt market will come down, which will compress the cap rates again? Or are they getting aggressive and actually decreasing the caps? Because if you think about it, and if you think to yourself, if you believe in the 8 to 10 year market cycles, which historically that's what we've had, and if you look at the trends on the debt, then one would suspect we might get into that cycle again. And if the debt rates come down, then that would translate into a tighter compression on the cap rates too. So I don't know. Most people said that they are not expanding or compressing the cap rate. I don't know what the right answer is. I definitely know to be conservative, you should still be expanding it. But
I think the right answer is exactly what you said, which is to stay in the question and not have an answer, because I don't think anyone has a completely true answer right now. I mean, the future will, everyone's got their predictions, but the future will show the truth.
I really like what you just said. And I think that's kind of a motto on life in general. You should always stay in the question. You should never be utterly convinced that this is the only way to do something. Just like how, what you asked me earlier is how was I able to scale so quickly? It's because I never took someone else's answer as the answer. I always questioned it.
You can't get bank financing.
Exactly.
You can't scale from not having any units to having 120.
Yep.
I know you had some, but not multifamily, right?
No.
Most people they think it's a stepping stone. It's chronological thinking versus create whatever you believe is possible for yourself.
I had 0 rentals during the time that I acquired the 124.
0 to 124.
Exactly.
There you go. Well, what would you say for people that, they're kind of overwhelmed by getting into real estate and, they know they want to, there's something calling them, but they really get stuck in that analysis paralysis. They get stuck in the fear of losing money and making a mistake. What would you suggest for anyone that's in that space now?
I think you first have to identify the root of the fear and you have to dissect it, because if you define your fear and then get to the root behind it, then you can start to solve that fear. So if you think that you're going to lose all of your money, understand what does that look like? What would happen if worst case scenario and then worst case scenario and then worst case scenario, and all of a sudden you have no money, and what does that look like? And how do you prevent that from happening? Maybe, for example, you lead with value and say, oh, I'm really good at marketing. Maybe I can leverage this skill set and partner with someone and do all of the marketing. And that way I put in sweat equity so I don't put my capital at risk. And even though you understand where the root of your fear is, you kind of shift the focus of that exposure and instead provide time and provide value in another capacity that translates into value to partner. That's one way to do it. Another way to do it is to dissect the fear and understand the fear and put safeguards in place that you don't have complete exposure. So if you have the ability to invest, let's say, $25,000, instead you invest $10,000 and you have a $15,000 safety net. So you build out your safety nets and you figure out workarounds that don't allow that fear to be completely exposed and vulnerable.
That's a very practical advice, that most people are going to talk more. I've asked similar questions, and a lot of times it's like, oh, you got to get your mindset right. You got to get around a mentor, someone that's doing it, which can help too.
Absolutely.
But I really like that, so dissect your fear, get clear on what are you actually afraid of, and then you can figure it out.
Exactly.
Right.
It's all figure-outable.
It's all figure-outable. I'm gonna steal that. Did you come up with that? Was that your saying?
I'm sure someone else did, but I don't know if someone else did. I've always said it. I don't know where it came from.
We'll give you credit for it then.
All right, I'll take it.
Until someone comes after us, right?
Yeah.
So what other words of wisdom could you share with anyone in terms of overcoming obstacles, building a team, or just in general? I know you talked about systems and processes, and it sounds like you're real big on details. What do you think, for yourself was the thing that set you apart?
I always say I didn't get to where I am today by doing what everyone else did yesterday. And I think taking that approach of just being okay with doing something different and questioning things can really open up a lot of opportunities. So I think today a lot of people are focused on all of the negativity, and everyone's really fearful of what's going on, and everyone's saying, oh, I want to just hold until the market gets better. And you can be successful in any market cycle, and you can be successful in any market, and you can be successful building different teams or going by yourself. You just have to commit to something and really question whenever anything is challenged to what you want to build. And for me, that's the approach that I've always taken. My best friend and I, so she is someone I met through real estate. She was our regional property manager on that 124 unit. And now we're to the point where we have matching tattoos. And we just say, whenever anything gets hard, just focus on going north. We always say north, baby, like to each other. And it's just... Is
that the tattoo? North?
It's a North Star.
North Star. There you go.
And the whole reason behind it is because there's always a way to figure something out. There's always a way to figure something out. And things are hard, but choose your hard. It's hard going to work 9 to 5 every day. It's hard not having a good retirement strategy. It's hard raising a family. It's hard renovating a house that you're living in. It's hard living paycheck to paycheck. Choose your hard. You're going to have hard situations in your life, no matter what you choose, whether it's real estate or any other career path. But at the end of the day, if you have your why very clear and you have your vision as to where you want to go and why you want to go there, that is the hardest part to figure out, in my opinion. And the second hardest part is figuring out who you are as a person to be able to figure out the strategy to get you where you want to go. So, I coach people, and I did private coaching prior to our group coaching. And the number one thing that I kept seeing time and time again is something that goes back to a quote, and I forget who says it, but it's something to the effect of, I don't want to spend my entire life climbing up a ladder to only get to the top and realize that it was on the wrong wall. And I think a lot of people focus on their W-2 and they say, oh, I just want to be CEO or I want to be a VP. And they don't realize what that comes with, myself included. When I worked in pharma, I worked 130-hour weeks, no joke. And it was at the sacrifice of my relationship with my now husband and the sacrifice of friendships and networking and doing things in my 20s that, every other 20-year-old was doing, because I was so focused on, well, if I can be a CEO of a top pharmaceutical company, money will never be an object for me. I'll be able to do whatever I want. I'll be able to live the life I want to live. I'll be able to be there for my family. But what I didn't realize is I would have already sacrificed my family along the way, and I wouldn't have had a tight-knit family
and a very
at the
long
end.
Portion of your life.
Exactly.
Right. The speed at which, the velocity at which you could create that financial freedom, and what you're doing now is totally different. Yeah, I heard a lot in that. And I know for us, the guiding North Star is key, because if you get clarity on that, when you talk about figuring things out and dealing with what's hard, our minds are going to naturally take the easy path of least resistance. So we're going to look for who's doing this easier. What's the easier way to do this versus, no, we're going this direction. Yeah. Let's figure out how to get there. And that's what I really heard in what you're saying, is getting so clear on that why, that it gives you that grit and that, sustainability to stay in the questions and stay motivated, stay focused. And I guess that's the answers, is how you got to where you're at, keeping your mindset like that. Obviously you're intelligent and, surrounded yourself with the right people as well. So yeah, hopefully there's some value in that for the guests, anyone listening. We appreciate you coming out, sharing your knowledge. And I know you do offer coaching, as well as, you guys have a lot of information on both of your sites. I'll let you tell the audience it's Bar Down Investments and the
Yes.
Apartment Addicts, and tell them what you do.
So Bar Down Investments, we are a real estate investment firm. If anyone is interested in diversifying their retirement strategy, offsetting potential tax exposure, you can find out more information at bardowninvestments.com. If you are interested in actively purchasing multifamily properties, regardless of the size, you can find out more information on different program offerings that we offer through apartmentaddicts.com.
And it's not a bunch of fluff. It's real meat and potatoes, actual,
It is.
like underwriting of deals and how to source deals.
We have a dedicated underwriting coach in Apartment Addicts, so you can schedule at any given time for support. And that underwriting coach is actually a broker. So a lot of people don't realize that you can make an offer on a property, and if you've underwritten incorrectly or your margins are too tight, you might not even be able to get debt financing. So this safeguards you from that exposure so that you will be able to get debt financing on your property the way it's underwritten.
Well, thank you again for your time. We appreciate it. Any closing words, any suggestions?
No, I just appreciate it, and go out and dream bigger. That's the name of the game.
Well, thank you.
Thank you so much.
Thank you for tuning in to the Investor Agent Podcast today. We hope you found it valuable. Please tune in weekly at theinvestoragents.com.